Recent reports that Venezuela's president was taken away and detained triggered a very strong reaction from China. You could see Chinese officials speaking out repeatedly, describing the incident as a serious violation of national sovereignty and a disruption of international order. The tone was noticeably harsher than China's usual diplomatic language. This reaction was not just about supporting an ally. It reflected a deep level of anxiety inside China. From Beijing's perspective, this was not simply a crisis in Venezuela. It was a highly dangerous precedent. A government that had worked closely with China, received large-scale Chinese financing, purchased Chinese weapons, and aligned itself with China's geopolitical strategy was suddenly left unprotected under U.S. pressure. That signal hit China directly. This is why China appears so angry, not because of emotion, but because of cold calculation. The incident means that China's past investments in Venezuela, its loans, oil arrangements, energy strategy, and even its broader plan in Latin America may need to be reassessed almost overnight. More importantly, the United States demonstrated something very clear. Even if you are on the other side of the world, once you are seen as a key strategic node, you can still be dealt with directly. And that is why today I don't want to focus on what will happen to Venezuela next. What I want to break down is the price China may have to pay as a result of this. If you ask why China has grown so close to Venezuela, the answer is actually not complicated. First, Venezuela holds one of the largest proven oil reserves in the world, but at the same time it has been under U.S. sanctions for years, short of cash, short of investment, and short of allies. China, on the other hand, is the opposite. It has capital, industrial capacity, and large state-owned companies. What China needs most is a stable energy supply and space to operate outside the U.S. dollar-dominated system. Because of that, this relationship was never built on trust from the beginning. It was built on mutual necessity. China did not lend money to Venezuela out of charity. It exchanged capital for oil, infrastructure contracts, and a strategic foothold in what the U.S. traditionally considers its own backyard. For Venezuela, once Western capital withdrew, China became almost the only country willing to step in at scale. But the problem lies precisely here. This kind of cooperation is not a normal commercial relationship. It is highly politicized and highly dependent on regime stability. Once the political leadership changes, the entire calculation can be forced to start over. When people talk about the China-Venezuela relationship, one of the first questions they ask is, did China lend Venezuela $100 billion US? That figure is not accurate. Based on public data and estimates from multiple research institutions, over the past decade plus, China lent Venezuela roughly $60 billion US in principal, mainly through policy banks, especially the China Development Bank, not $100 billion. But the real issue is not the size of the number, it is the structure of the lending. These were not traditional sovereign loans. They were so-called oil-for-loans arrangements. Venezuela did not always repay in cash. Instead, it repaid by delivering oil. From China's perspective, this looked relatively safe on paper. Physical oil instead of promises. For Venezuela, it provided immediate cash to stay afloat. The problem is that this kind of debt is tightly bound to a specific political regime. As long as the government remains in power and oil keeps flowing, China can gradually recover its costs. But once there is a change in government, everything changes. A new administration can argue that these debts were signed by the previous regime, that they were linked to corruption, or even that they were illegitimate debts. In theory, they can refuse to recognize them or demand renegotiation. In other words, the real risk China faces is not simply losing $60 billion. The real risk is whether an entire model, trading energy for geopolitical influence, can suddenly stop working overnight. And that is a risk that cannot be measured on an accounting balance sheet. On the surface, China's oil trade with Venezuela looks fairly straightforward. Public data shows that roughly 60% to 70% of Venezuela's oil exports ultimately end up in China. But that raises an obvious question. Venezuela has been under long-term US sanctions. So how does China actually buy this oil legally? The answer lies in a gray but well-documented supply chain. Venezuelan crude is first transferred at sea through ship-to-ship operations with other tankers. It is then moved to offshore areas near Malaysia, where the cargo is redeclared and relabeled as so-called Malaysian blended crude. From there, it can be officially imported into China. Multiple international media outlets, including Reuters, have reported in detail on how this system works. What's important is that the main buyers of this oil are not China's national oil giants, like CNPC or Sinopec. Instead, the real buyers are a cluster of local, privately owned refineries concentrated in Shandong province, commonly known as Shandong Teapot refineries. Their business logic is simple. They don't pursue political missions, they pursue the lowest possible cost. Heavy, deeply discounted Venezuelan crude is exactly the kind of feedstock they rely on to survive. And this is where the vulnerability lies. If Venezuela's government changes, or if it shifts toward a pro-US alignment, this Malaysia blended oil route could be cut off very quickly. At that point, China wouldn't suddenly run out of oil, but it would be forced to buy more expensive oil. The first place to feel the impact would not be Beijing, but Shandong. Refinery costs would rise, profit margins would be squeezed, and some operators might be forced to cut production or even exit the market entirely. More importantly, this episode proves something much bigger. The United States does not need to impose a full-scale energy blockade on China. By targeting just a few critical routes or specific sources, it can already generate real economic pressure. And that, more than anything else, is what truly unsettles Beijing. If you look at the China-Venezuela relationship only through the question of whether China has oil or not, you are missing the bigger picture. For China, oil is not just an energy issue. It is also a currency issue and a system-level issue. In today's world, oil is almost entirely priced and traded in US dollars. This is what people refer to as the petrodollar system. For years, China has been trying to do one thing: gradually weaken the US dollar's dominance in global energy trade. One of the most important potential breakthroughs for the internationalization of the renminbi lies in energy settlement, and Venezuela was, in theory, an ideal testing ground. It was under Western sanctions, had limited options, and as long as someone was willing to buy its oil and provide financing, the choice of settlement currency was open for discussion. That is why China's cooperation with Venezuela was never just about oil for loans. It was an attempt to bind energy, financing, and the renminbi into a single long-term strategic framework. In other words, the impact on China is not immediate, and it is not explosive. It is a long-term, structural weakening. And this kind of erosion is often far more difficult to absorb than a one-time loss of tens of billions of dollars. If we look back at the China-Venezuela relationship, it becomes clear that from the very beginning, it was never an equal or stable partnership. It was a high-risk transaction built on regime stability. China exchanged capital, oil cooperation, infrastructure projects, and weapons for energy supply and geopolitical influence. Venezuela, in turn, used its identity as an anti-US government to serve as China's strategic foothold in Latin America. The problem is that once the regime begins to wobble, the entire calculation starts to collapse. Debts can turn into bad loans, shadow oil routes can be cut off, the energy plus renminbi strategy loses its testing ground, and as a result, China's influence and credibility across Latin America are forced into reassessment. These are not sudden, explosive shocks. They are slow, structural internal injuries that weaken a strategy over time. So what the Venezuela episode truly reveals is not just the future direction of one country, but a much larger question. How long can China's model of trading capital, energy, and political alignment for influence survive in an era of great power competition? That question does not apply only to Venezuela. It applies to Latin America as a whole, and ultimately to China's future approach to overseas strategy. If you want to keep watching analysis that goes beyond headlines and looks at the real geopolitical and economic risks facing China, make sure to subscribe to this channel. Thank you for your support.